Hello, everyone, and welcome to today's exclusive webinar brought to you by Vantage. The topic that we're going to explore today is understanding market structure. We've kind of done this before. You know what? I was wondering why none of you were replying me because I was asking a question and nobody replied me. So I guess it's because you guys couldn't hear me. Anyways, so understanding market structure, can you guys let me know in the chat box if we've ever done Wyckoff method before? Okay. Thank you so much. Okay, so now that we've got and no for Wyckoff method. Thank you so much. Okay, so it's good that we're learning this topic today, and I'm gonna talk about the Wyckoff method a bit in today's topic, which it kind of helps. Okay, so now that we've got the technical checks out of the way, let's warm up a little. How's everyone doing today? How's your trading week going so far? Are you in profits? Are you in loss? Some of you might have caught a nice trend. Some of you, struggled with the choppy markets. That's normal. It's okay. That's part and parcel of trading. I already know where most of you are from. I see a lot of regulars here. I kind of like that. Okay, so let's just jump straight into it so that we have more time with the questions and answers today. I don't want to spend too much time on the introduction so that we have more time on the topic and then more time on the questions. Okay, so again, before we actually jump into anything, we need to pause for a quick and important part of the webinar, which is the disclaimer. Now, I know a lot of you here are regulars and you've been through this a lot, so this is more for the new people. So everything I'm about to share with you guys today is purely for educational purposes. It's meant to teach you concepts, frameworks, and ways at looking at the markets that I personally use and believe in. It's not meant to be financial advice. It's not meant to be investment advice. It's definitely not a signals group where I tell you to buy or sell. Okay, so why is this important? Because every single one of you is different. You all have different account sizes, different risk tolerance, and different time commitments, and even different goals in trading. Some of you may just want to grow your capital slowly over time, while others are looking for more active trading opportunities. If I give you a one-size-fits-all instructions, it simply wouldn't make sense because trading is such a personal journey. Okay, so just a quick reminder that trading is very risky and you shouldn't risk more than you're willing to trade. Please, again, take this webinar purely as educational. We are not here to give you any kind of advice. We are merely here to share knowledge about trading, and what you do with that knowledge is entirely up to you, whether you want to implement it into your trading or not. It's purely up to you. Again, everything I share today is based on my own trading experience and based on my opinions on how to be better in trading. This is how it has helped me. It may not help you, it may help you, but you need to implement it into your trading to find out by back testing. Okay, so I'm gonna stay here for a minute so you guys can read through the disclaimer because this is very important, legally. I don't want you guys to be misled. Okay, so I'm just gonna stay here. I don't know why I think I had so much salt today. I keep drinking water. I'm so thirsty. Constantly feel dehydrated. It doesn't help that I have to talk so much in these webinars. So yeah, sorry about that. I'm gonna have a lot of water breaks, but yeah. Okay, cool. I think everyone's good with the disclaimer, right? So let's move on. So for those who don't already know me, my name is Cassandra. You guys can call me Cass. It's less formal, it's easier this way. I am an investment analyst and a prop trader. So I am an investment analyst from a research firm called Everest Fortune Group, which is recognized globally as the finalist for the best Forex and best equity research for multiple years running. Okay, my role there is basically to do deep market research from macroeconomic analysis to technical price actions to news to whatever it is. Okay, I basically specialize in the markets. I spend a lot of time researching, back testing, forecasting, and just testing out strategies on the market to see what works. Okay, on the prop trading side, I am a funded trader by multiple different companies. Okay, that means that I've passed tests to get me funded. Those tests require me to do 10% profit within a month to get funded. So doing 10%, I wouldn't say is like difficult, but I wouldn't say it's that easy either because not many people have passed this test. It's not that difficult because if you follow a set of rules that make sense and like this, like just like responsibly follow the set of rules, it's not that hard to hit the target. Okay, so the hard part is actually following the rules. Okay, so the reason I share all of this is not to brag, but to give you confidence so that you are assured that the person guiding you today is someone that is in the markets a lot, who is looking at the charts a lot, and is a topic expert. Okay, so my goal is to make sure you leave this session with insights that are practical, relevant, and applicable to your trading journey. Okay, so our agenda for today will be to look at what is market structure, how to identify breaks and shifts and market phases, accumulation, expansions, and distributions, and then we're gonna do like an intense practice session on the charts if time permits. I think time will permit because I don't really have a lot of slides. Just a reminder, today's topic is very easy. This is like the foundation, like the basic parts of trading. Okay, so what is market structure? It is basically, it's so basic, but it is so important because if you cannot master identifying market structure, I can tell you it's going to be very hard for you to last long in this trading game. Okay, it's going to be super hard for you. Okay, so let's cover today's topic. Very basic, but because I'm implementing Wyckoff method into it, it might become a bit more in depth. Otherwise, if we're just talking about market structure, it's gonna be so easy. It's just gonna be like higher highs, higher lows, swing support and resistance. You're gonna get it in like 5 minutes. That's why I'm implementing like Wyckoff method, which is a bit more in depth, a bit more advanced so that you can understand it a bit more in depth. Obviously, I can't go like all in because this is only a 1 hour webinar, but I'm just covering as much as I can. So what exactly is the market structure? So when trader says market structure, we're talking about the grammar of price, the way price forms swing highs and swing lows, how those swings connect into trends or ranges, and how those patterns repeat across multiple time frames. Okay, so it's not about a specific indicator, it's about reading the market's body language. Okay, there are two evergreen question structures to answer. Okay, so the first one is who is in control, the buyers or the sellers, and where are they likely to defend or surrender next? In an uptrend, the market will print higher highs and higher lows, and in a downtrend, we see lower highs and lower lows. Okay, so that's very clear how to identify an uptrend or a downtrend. But neither side can push decisively. We get a range. So equal-ish highs and equal-ish lows, and it's choppy, and there's a lot of indecision. You know that's when the market is moving sideways. So this isn't a new idea. It goes all the way back to the Dow theory, which is like the late 1800s to like early 1900s, which proposed that the market move in trends and those trends have phases. So those phases is accumulation, okay, public participation, which is like expansion or markup, and then followed by distribution. So later, Richard D. Wyckoff, which is what we're going to talk about today, expanded the tape reading philosophy. Price moves reflects the campaigns of large operators and the interaction of supply and demand. So a crucial concept, market structure is fractal. Okay, what you see on the 5 minute charts often mirror what you see on the daily charts, just like on a very compressed point of view. Okay, so that's why a trader can be wrong on micro but right on macro or vice versa. So the trick is to align time frames, Let the higher time frame provide the backdrop, then execute on the lower time frame. Okay, that's why for me personally, if the higher time frame is showing me a buy and the lower time frame is showing me a sell, I usually don't get into that trade because it's too conflicting. Okay, so for me, like the higher time frame, oh my goodness, there's 2,000 of you today. 2,050 of you today. Okay, so if the higher time frame is like on an uptrend and the lower time frame is on a downtrend, it immediately makes me want to like step back and say like, okay, maybe this is not the chart or the pair that I want to trade with because there's conflicting information at this current point of time. So when we say understanding market structure, we're really saying learn to read the sequence of higher like highs and lows, the story of control and the phase the market is in. So your decisions are grounded in context and not in guesswork. So that's why I always say like, how do you differentiate trading from gambling? Like gambling, there is no data, right? There is no like logical data. There's no stats to how something will work. I mean, if there was, then it wouldn't be gambling anymore. But that's the difference between trading. Trading is a continuation, it's a constant repetition of patterns, right? It's like price is constantly doing this, it just at different times. Maybe it did this pattern in January of like 2022 and now it's redoing that same pattern again. So it's just a repetition of patterns. That's why it's not gambling because you're using data and using data to predict what's gonna come like in the future. Okay, so let's get practical with the building blocks. Everything starts with swing identification. A swing high is a pivot where price failed to make a new high and turned down. And a swing low is the mirror image. Mark those reliably and half the battle is won. Okay, if you can identify swing highs and swing lows and trends, I can tell you honestly, half the battle is won. A lot of things you will notice that you will be able to catch like directionally you will be correct. So then it's more like identifying where to get in for your entry, your stop loss and your take profit. So identifying trend, identifying swing highs, swing lows, and structure is winning half the battle in trading. And the other half is identifying, like narrowing down where to get in for your entry, your stop loss, and your take profit. I mean, there's other things as well, like trading psychology and like risk to reward and like whatnot. But basically, this will help you win half the battle. Okay, so from there, two labels are your best friends, which is BOS, which stands for break of structure, and CHOCH, which stands for change of character. Okay. Give me a sec, guys. I think Vantage is telling me something. Okay, yeah. They're telling me that everything's working fine on their side as well. Let me just update them that it's working. Okay. Okay, so breakup structure occurs when price takes out the most recent swing in the direction of the prevailing trend. In an uptrend, breaking the prior swing high is a breakup structure, which means that there is a trend continuation. In a downtrend, breaking the prior swing low is a break of structure and the trend is still healthy and this trend is still going. So a change of character happens when price first breaks a swing in the opposite direction of the recent impulse. Okay, yeah. I thought I didn't key in, but yeah, there is here. So there is a change of structure here where this is the swing low and you can see price breaking that swing low. instead of breaking this swing high to the higher side, it now breaks that swing low and does a change of structure. So it happens when price breaks that swing in the opposite direction of the recent impulse, hinting that momentum is shifting. It's just a hint, by the way. It's not confirmation. Okay, it's just a suggestion. For example, a series of higher highs, higher lows. Okay, price breaks the last higher low. That's your early alert. That structure might, okay, it's very important here, might be transitioning from up to range or down. Okay, so change of structure means that there's a possible reversal or at least a caution. Okay, it's just like a warning sign, but it's not confirmation. Okay, it's not 100%. So you also hear about external and internal structure, which is external or macro refers to the dominant swing map you draw on a reference time frame, for example, like the H4 or the daily, and internal, which is kind of like micro. Shouldn't there be break of the lower that from the last high? Not sure if it's clear this way. Hmm? Shouldn't the change of structure be the break of the low that formed the last high? The break of the low that formed the last high. Sorry, I'm trying to like understand. Let me delete everything. By the way, guys, especially those on Zoom, why can I not erase anything? Especially those on Zoom, don't be shy, just ask questions. Don't feel like you're delaying. Don't feel like you're delaying the webinar because remember today's topic is super, super easy. We're gonna have a lot of time for question and answer. Okay, I don't know why this is not erasing, but yeah, basically, it should break here. Is that what you're asking? Um, yeah, okay, so if it breaks here, that's gonna be an even stronger indication that there's a possible trend reversal. But if it just breaks this first one here, where it's doing this, right? So if it breaks here, it breaks here, it's a break of structure. It breaks here, it's a break of structure. But now, if it breaks, it does this, but it doesn't break here. It moves up, but it doesn't move all the way up. It only moves up a bit and then comes down, breaking this side instead. This is a change of structure. Okay, it's change of character, sorry. And this is an early sign of trend reversal. So this is just an early sign, but a better sign would be if it breaks here. So I understand your question. It's just that where it breaks will give you more strength. Okay, if it only breaks here, it's just an early sign, but if it breaks here, then that's like a, I wouldn't say a confirmation, but it'll just give you more confidence that it's a possible change of trend. Okay? Okay, guys, I don't know how to get rid of that, honestly. Okay, it doesn't matter. Okay, so now let's tie structure to classic framework so you can recognize phases, not just patterns. Okay, the thing about trading, right? Your job as a trader is just to collect as much information as you can. So breaking this first one would have given you some information. Breaking the second one would have given you more information. If it breaks this third one, it would have given you even more information. So you're just basically collecting information to make a decision. Okay, so the Wyckoff method divides a campaign into accumulation, smart money quietly buying within a range. Okay, smart money basically means smart money. Okay, sorry guys. I know it's like I'm trying my best to like implement this topic into today's webinar because I'm trying to go a bit more in depth because today's topic actually, honestly, if I don't talk about Wyckoff, today's topic is going to be so simple. I'll be done in like 10 minutes. So I'm trying to talk about Wyckoff so that we can go a bit more in depth. We can like understand market structure in Wyckoff's point of view. Okay, so it's going to be a little bit more like advanced. So if you don't understand anything at all, don't be shy. Just ask in the chat box. Because if you're not asking, then you're not really absorbing the information you need to absorb. So don't be shy, just ask. Don't worry about delaying the webinar because trust me, I can finish this in 1 hour. Okay, so by the way, smart money means the big players like the banks, the hedge funds, the institution, basically the people with the big money. So you guys know that the Forex market moves $1 trillion or more in a 24 hours period, right? On a daily basis, trillions of dollars are being moved by the markets. Okay, when I say the markets, I mean the banks, the institutions, the hedge funds, the big players, the rich people. Okay, people like you and I, the retail traders, we cannot move the markets because, like, for me, I consider myself very big, my account very big. So I have like a $300+ account, and for me, it's like that's very big. But in the eyes of the market, what is $300,000? What is $1 million? What is $10 million? It's such a small sum compared to what is actually being moved in the market. So the smart money is the one moving all the big money, okay? So anytime I say smart money, just know I'm talking about the big players, okay? So accumulation is when the smart money is quietly buying within a range, okay? So price is ranging and smart money is buying. So then there is a markup. Okay, sorry, this was a bad photo to put in here, but yeah. Markup meaning that there's a trend up. Distribution meaning that smart money is unloading within a range, and markdown, trend down within those phases. Wyckoff observes events and tests. Okay, so the first event is called the selling climax, which is here. Automatic rally, secondary test, and secondary test here. Spring. Don't worry, guys, I will explain all this in a while. Sign of strength, which is SOS, supposed to be somewhere here. And then last point of support. Okay, I'm gonna explain all of this in a bit. Okay, so let me just erase all of this and I can explain. So selling climax, automatic rally, secondary tests is an accumulation. Okay, so phase A is an accumulation. Later, we have the spring, which is the false break below range. Okay, there's always going to be a false breakout. This is often to trap late sellers before a sign of strength and a last point of support kicks off the markup. So in distribution, you may see buying climax, okay, automatic. Okay, don't get confused, guys. This is basically thing. So someone said, can you repeat that again? Okay, I understand that it's confusing. Don't worry so much about these names. These are just names to identify it. Don't worry. Even for me, I still need to reference the names. Okay, I still need to reference the names. Okay, so don't worry so much about the names. Just know that this is what usually happens. So price comes down, price accumulates, then there's going to be a fake out. After the fake out, then they start buying in, and then you see price going the other direction. Okay, don't worry so much about the names. Okay, so in a distribution phase, right, the name is different. So you'll have buying climax. So this will be buying climax, and it's also going to be on the other direction. Okay, automatic reaction, uptrust, U-TED, and last point of supply is basically the same thing, but in opposite with different names. Okay, so don't worry so much about the names. More importantly, understand the market psychology of this. The market psychology is there's going to be a selling climax where there's exhaustion of like selling or buying, and then price is going to range, and then there's going to be a fake out where they do it on purpose to like stop you out, and then it continues. So Wyckoff's 3 laws are structure goals. So the first one is supply and demand. Price rises if there's demand. If demand is higher than supply, there's a fall if supply is higher than demand, and structure is just that law written on a chart. So cause and effect is the length of the depth and the range, and effort versus results is you compare the volume effort to the price progress. Okay, we'll talk about that in a while. Don't get confused. So to overlay that with the simplest structures model, it's basically impulse versus correction. So impulses are directional legs with strong body candles and decisive structure breaks, like break of structure. Corrections are overlapping, slower pullbacks that respect prior structure. If your impulse can't break anything meaningful, it's probably not an impulse. So finally, there's liquidity as well. Structure tends to leave resting orders above equal highs and below equal lows. Those obvious clusters are magnets. A classic structural trap is the liquidity grab. Price runs the higher highs and lows and collects stops. Okay, they do this by doing the springs, okay, by doing fake outs. So these fake outs, these springs are done on purpose by institutional players so that they stop retail traders like you and I out so that there's money to be made. Remember, trading is a zero-sum game. For someone to win in trading, someone has to lose. Okay, for someone to win in trading, someone has to lose. So yeah, sorry, I'm trying to erase it, but it's not really erasing. Okay, so to win in trading, someone has to lose, right? That's why they're purposely doing all this fake out so that you and I get stopped out and there's actually money to be made. Okay, so let's convert structure into repeatable playbook you can use on a daily basis. Let's do the top-down bias. First, open the higher time frame. Mark external swings. Okay, mark external swings. For example, you can open the weekly, the daily, the H4, and the most recent break of structure or the change of character. We are structurally bullish, bearish, or ranging. So you need to ask yourself, is it bullish, bearish, or ranging? That's the question you need to ask yourself. So if you look at this weekly example right now, would you say we are bullish? Yeah, right. Okay, thank you so much, Muhammad. So you don't know if you are bullish because there is a break of structure here and there's a break of structure here. And then obviously there was a very big pullback, but if this continues higher, then there's gonna be a break of structure again. Okay, so this could be a uptrend on the bigger time frame. So I know I'm focusing on the smaller ones because there's not much information to look at here. Okay, on the daily, it's obviously an uptrend because we can see that there was a clear break of structure here. And similarly, on the hourly, there is a clear break of structure here. Okay, so I would say all three are moving on an uptrend. That's what I say about top-down bias. You need all the different time frames to kind of give you the same bias of whether it is bullish, bearish, or ranging. Okay, so define the map. Where is price relative to the map? Is it in an uptrend? Is price pulling back into prior higher lows or demand? In a range, are we near the extremes like because if you're near to the extremes, it's better risk to reward. Or are you stuck in the middle? Note any liquidity pulls like equal highs or lows, basically when price is moving sideways and price might want to rate before a real move. Okay, so then you drop time frame for execution. You go to the smaller time frames. If you're referencing the daily, you can go like to the H4, the H1, maybe even 15 minutes if you want to. Okay, and then inside the pullback, look for a micro change of character back in the direction of the higher time frame trend. Okay, or a clear retest of the zone with rejection. Don't worry if you don't understand what I'm talking about. Later when we go in the charts, I'll try to explain it to you. I'll show you guys how to do it on the charts. Okay. So then step number 4 is to trigger and manage. Okay, so typical triggers will be retest and rejection of a broken structure. So all resistance now becomes the new support in an uptrend. Micro break of structure in your favor, that means going to the lower time frame. Liquidity grabs that springs back inside the range, followed by a BOS confirming the trap. Stops and go where structure says you're wrong, below the swing low or above the swing high. Okay, step 5 is to adapt to the phase, whether you're in accumulation, distribution, expansion, or transition. Okay, you need to adapt to where the phase is. So the common mistakes to avoid is chasing price between levels. Okay, so let's say price is moving in a range, okay? It's moving in a range and price is here right now, right here. And you're just chasing the range, okay? Don't do that. Wait for price to get to either the resistance or the support so that your risk to reward makes more sense. Okay, so that your risk to reward makes more sense. So treating zones as a single line, that's another thing. Okay, your zone should always be a zone rather than one single line. And then trading internal flips against strong external trend. Okay, so how to identify breaks and shifts? When we talk about break of structure or BOS, we're talking about the market confirming that the existing trend is still healthy. Okay, imagine price is moving up with higher highs or higher lows, okay, or in this example, lower lows and lower highs. Okay, when the market pushes below the previous swing low, that's a break of structure. It's the market saying, yes, the sellers are in control. So the same goes with an uptrend. If you see the break of structure of higher highs, it means that the buyers are in control. Why does this matter? Because break of structure events are where momentum and structure meets. If you're waiting for trend confirmation, break of structure is one of the cleanest signs you can use. Many traders get faked out by minor fluctuations, but break of structure focuses only on the important swings, points, filtering the noise. It also allows you to define your risk. If break of structure doesn't hold, you know where your trade thesis is invalid. Okay, so let me, this, obviously, anything that I share with you guys on the webinar, okay, I know some of you must be wondering, but I'm learning so many things. If I learn something else, they'll teach me to trade a different way. Okay, so if I have to give priority to whatever you are learning, I would have to say price action is always priority, okay? Price action is always priority to indicators. I know like you join the webinar every week, we're teaching a different topic, but this topic I would have to say has priority over all other topics, okay? You need to master price action, you need to master market structure before you can even win in trading, before you can even implement indicators. Indicators are just supporting technical analysis that will help you make your decision better, but it should not be your main decision maker. Okay, so now if break of structure tells us that trend is continuing, then change of structure tells us that something different. There's a possible trend reversal. Imagine the market has been printing higher highs and higher lows. Suddenly, instead of continuing that pattern, it breaks the last higher low. That's a change of character. It doesn't confirm a full reversal yet, but it is a red flag that buyers may be losing control and sellers may be stepping in. Okay, think of change of character like the market whispering, hey, something is changing here. If you catch the change of structure early and combine them with context and combine them with other things like indicators, support resistance, supply and demand zones, liquidity graphs, and volume analysis, they can give you a head start on new trend. But here's the key, not every change of character leads to a full reversal. Okay, sometimes it's just a signal. Okay, it just signals a deeper correction before a trend resumes. Okay, that's why you always need to pair change of character with confirmation and higher time frame structure. That's why you need to learn other things in trading. That's why there's so many things that you need to learn in trading so that you can implement all of it together to give you a very high probability analysis. Okay, so this is example of change of character. I think Gyula was asking just now, shouldn't it break? Okay, this is a good example of how it broke the last swing low. Okay, so it made a break of structure here and then it came back down and broke the swing low, showing a change of character. Okay, this is a very good example. Okay, so let me continue. I want to finish everything so that we can go into the charts. One of the biggest challenges traders face is distinguishing a real break from a fake one. So the market loves to play tricks. It pokes above resistance, triggers breakout traders, then immediately dumps back down. Okay, that's why if you guys have been following me for a while, I've always told you guys that I am not a breakout trader. I don't like catching breakout because for me, for some reason, every time I catch a breakout, it turns out becoming a fake out. So it dips below support, lures in shorts, and rips higher. So how does this filter the noise? A true break of structure often comes with a strong candle close beyond that level, not just the wick. Okay, it needs to close above. The body needs to close above. Okay, I know this is also closing above. That's why this is a fake out. Okay, there's other things as well. Okay, often supportive volume showing effort behind the move. Okay, so things that we use in the Wyckoff method is to combine volume. I'll show you guys later. Okay, how to combine volume. On the other hand, a false break of structure, often called a liquidity grab, leaves long wicks and quickly reverses. This is why Wyckoff concepts like spring and uptrust are so relevant. The market hunts liquidity at obvious levels before making its real move. A practical tip, don't assume every break is real. Wait for the close. Watch for reaction and ask, is price accepting above this level or rejecting it? Okay, that simple question will save you from a lot of fake outs. So let's put into simple workflow so you can use. Start with a higher time frame. Sorry, I used the same photo. Okay, is the market trending up or trending down or ranging? So you always have to ask yourself, is it up, is it down, or is it sideways? Okay, that's the first thing you always need to ask yourself. Identify the most important swing highs and swing lows to see if there's a break of structure where trend is moving. Okay, then now drop to your lower time frame and look for a break of structure or a change of character. This is where you'll see the actual trigger. Remember, break of structure equals to continuation and change of structure equals to potential shifts. Okay, number 3, confirm the move. After the break, does price retest or respect the level? Does it reject strongly or continue with momentum? Thus, that confirmation is where the highest probability trades live. Step 4, manage risk by placing stops at structure. If you're trading a bullish break of structure, your stop goes below the retested structure low. If you're trading a bearish change of character, your stop goes above the failed high. Okay, this workflow keeps you aligned with the bigger picture while still giving you precise entries. You're not just chasing every little candle, you're letting the market structure guide you trades step by step. Okay, so let's look a bit more in depth into the Wyckoff method before we go into the charts, and then we do like a really quick practice session. Let's start with the market phase accumulation. So this usually happens after a decline. When the market has already sold off heavily, price starts to move sideways in a range, almost like catching its breath, but what's really happening under the surface is the large players like the smart money are quietly accumulating position. Okay, so the smart money, every time you see price ranging, what's really happening is the smart money is actually deciding, do I want to sell more or do I want to buy more? And they're just deciding. Okay, they're basically just deciding what's going to happen next. Okay, why do they do this? Because they bought everything they wanted in one go. If they bought everything they wanted in one go, the markets would spike and they'll lose their advantage. So they do it quietly, not to raise suspicion. So instead, the market trades sideways, they buy slowly, they absorb supply slowly. That's why during accumulation, you'll often see long wicks, lots of failed breakouts, and no real follow through. Wyckoff breaks this into events. It's called selling climax. Okay, again, don't fuss so much about the names, okay? Selling climax, where panic sells ends, automatic rally, okay, as buyers steps in, secondary tests, it comes back down again, retesting the lows, sometimes a spring, okay, sometimes a spring, a fake, which is basically a fake break below the range that shakes out weak hands. They do it on purpose so that you get stopped out. Then finally, a sign of strength, which is SOS, a sign of strength, and then a continuation and pushes it up with conviction to direction that it wants to, okay? So when you learn to spot accumulation, you stop shorting into the floor and instead prepare to catch the next expansion upwards. So accumulation, before I learned the Wyckoff method, I always see price moving sideways and I'm always like, okay, there's no trade. I'm always like, okay, the market is moving sideways. It's indecisive. It's just like there's nothing happening. But if you read within the market structure, if you read within the sideways market, you will see things like the selling climax, okay? You will see things like the automatic rally, the secondary test. You will see all this. You will see the spring. And then this will be your sign to know what the next direction is. And you know that the next direction is up. Okay. Okay, so once accumulation phases is complete, the market enters into expansion. Okay. Also called as markup in an uptrend or markdown in a downtrend. This is the phase most traders dream about. Strong directional trends where the structure is clean and the risk to reward is the best. Okay, in expansion, you'll see higher highs and higher lows in an uptrend or lower highs and lower lows in a downtrend. Candles are usually larger, momentum is clear, and sentiment shifts. Retail traders suddenly notice the moves and pile in, but smart money is already positioned from the earlier accumulation. Smart money already know what was happening here during the accumulation and the distribution phase. When price is going sideways, the smart money already know what is going to happen. They're already preparing the positions, whereas retail traders are usually late. They only get in when there's a markup or a markdown. Okay, they only get in when price is already going up or going down, and that's already too late because the smart money already got in way before you. This is where you want to be riding with the trend rather than fighting it. The key is to align with the higher time frame structure, catch the pullbacks, and let your winners run. Trying to fake expansion is like standing in front of a train. Yes, sometimes you catch the small reversals, but more often than not, you'll get run over. So expansion is where you build your account if you manage risk and stay disciplined. Okay, so lastly, let's talk about the distribution phase. After an expansion, okay, there's going to be distribution. Okay, this is the mirror image of accumulation. Okay, so this is basically just the other way of accumulation because it's now going down. But it happens after a strong uptrend. Price starts to stall, chop sideways, and then create a false breakout at the highs. Why? Because smart money, the big players who bought earlier are now offloading their position. They sell into strength while retail traders are still buying, thinking the uptrend will continue forever. Okay, this creates a kind of tug of war and the market looks like it's still bullish, but under the surface, demand is being absorbed. So Wyckoff terms, you often see buying climax, a big euphoric rally, then a automatic rally downwards. The market retests those highs with an uptrust or even an uptrust after distribution, a fake breakout to trap buyers, and then begins rolling over. So later you'll see last point of supply. Okay. You see sorry, where's my pen? You see a last point of supply where price retest the range lows but can't rally anymore. That's the telltale sign that the downtrend is about to start. Okay, it come and retest that trend, but it's just weak. It can't do it anymore. Okay, so understanding distribution protects you from buying at the top. Instead, you can flip your mindset rather than forcing longs. You prepare for the next markdown phase. One can identify Wyckoff method on any time frame, let's say down to the 5 minute or only higher time frames. You can identify the Wyckoff at any time frame, but you should still reference the higher time frames. Okay, we're done. So if you guys have any questions, do ask me right now, and then I will answer you. Okay, when you say reference the higher time frame, which one is the preferred one? Okay, it depends. Are you a swing trader, a day trader, or a scalper? Can you let me know in the chat box? Then I will be able to like reply you better. Okay, if you are a day trader, you want to be referencing the daily and then maybe down to the 4 hours and then maybe down to the 1 hour. Okay, but actually that's still a bit more to swing trading. Maybe you can do, yeah, daily 4 hours, 1 hour, and then 15 minutes. How do I know if a breakout structure is strong enough to trust? Okay, you want to look for a full body candle close beyond that level, like a full body, a really strong candle, ideally supported by volume and momentum. So it's just a wick poke. If it's just a wick that pokes out, then it's more likely going to be a liquidity grab rather than a true break of structure. Okay, I'm going to pull up TradingView. Okay, another question. How do I tell the difference between accumulation and distribution when both look like a range? That's a very good question. So the difference is that the position of the range and the behavior inside the range. So let me pull out. Um, this is very important. So you need to know, okay, this is the range for distribution. Okay, this is the range. Okay, you need to see how it's behaving within the range. Okay, by referencing these photos. I mean, obviously don't reference like, okay, this is how it's ranging, and you need to see the structure within the range, and then you'll see. So if you see a spring happening, which is a false breakout, like later on in that range, you kind of already know that this is an accumulation rather than a distribution. Okay, so after an uptrend, ranges are more likely distributions, and inside, watch for springs like bullish traps and upthrust to kind of know which one you're doing. Okay, so another question, is volume really necessary to confirm structure? Volume isn't mandatory, but it's a great confirmation tool. A break of structure with strong volume is more trustworthy than one with low volume. And mismatches, like high volume with no progress, can hint at absorption or manipulation. Okay, sorry, I'm gonna have to, if there's no more questions, I'm gonna pull out TradingView, and then we can go through it together. Okay, this is my own personal trading view. I need to delete everything on the charts. Okay, by the way, I'm selling Ethereum. I'll give you guys a really good example of where this worked. Let me just pull this up. You guys, okay, so this is a very good example of price going sideways before an accumulation, before a trend continuation. Okay, you see how price is going sideways on gold. I'm going to pull out the Wyckoff method so that we can reference, okay? Okay, let's just use this one. Sorry, I need to save this photo so that we have an image that I can use. So that we can reference this, okay, by the way. Okay, I'm gonna put this at the side so that, oh, do I just alternate tab? Okay, how do I know if this is an accumulation or a distribution? How do I know if it's an accumulation or a distribution? Okay, ideally, you want to first spot a exhaustion. Okay, there's gonna be some kind of exhaustion. So you can see here, it was already exhausted here. Like the price couldn't make higher highs. Okay, price could not make higher highs. It just finally stopped here. And then you can see that price was ranging here, ranging, and then a fake out, and then another fake out. Okay, these fake outs are meant to, oh, by the way, it doesn't have to be. Does that mean after an uptrend, it has to go to a downtrend? No, it doesn't have to be. It could be an uptrend. It could be an uptrend. You know what? I'm going to go on the daily so it's clearer. After an uptrend, you can see price kind of ranging. It doesn't necessarily have to go down. Okay. I know if you see all this, it's like uptrend followed by a range followed by downtrend. Like it's an opposite direction. No, it doesn't have to be like that. This is just what usually happens. It can be a trend continuation, but before that trend continuation, there is accumulation. Okay, so again, you need to ask yourself, is price bearish, bullish, or ranging? So right now, if we were right here, right now, we just don't look at this. This is not in the picture right now. Let's pretend that's not in the picture. We just focus on this part. We know that it's ranging. So when you find a ranging market and you use Wyckoff, it's very easy for you to know whether it's going up or down. So you just need to identify things, characteristics of Wyckoff. The first one is identifying a range. So we can see the top part that there was no fake outs happening, right? You can see the top part that there was no fake outs happening. So it makes me feel like there's a spring here, there's fake outs happening here. So this is one first sign that makes me think like, okay, the fake out is happening at the bottom, therefore it's going to end up becoming a buy. Okay, that is just one example. Okay, everyone good for now? This is one example of how to identify. Okay, so the first, obviously, you need to look at context as well. Okay, so what comes before the range? Is the range, was it like after a strong uptrend? Yeah, it was after a strong uptrend. Okay, if it's after a strong uptrend, most of the time, not all the time, it's more likely going to be distribution. Okay, it's more likely going to do this, then sideways, then this, okay? But not all the time. So this is an example where it didn't happen. This was an example where it did this, accumulated, and then did a continuation. Okay, this is one example, okay? Okay, so the second thing you want to look at is behavior inside the range. You want to look for the fake outs again. So we see the fake out happening at the bottom part, which is giving us a signal that it's going to push up rather than push down. So if the fake out happened at the top part, it will give me a sign that it's going to happen at the bottom. It's going to do a trend reversal. Okay, and then there's gonna be like exit clues. So accumulation usually results in a break of structure upward. So this part is a bit late already, where there's finally a break of structure, right? Obviously, you want to know what's coming when you're inside here rather than when price is finally here. But this is your last line of like, this is your final form of confirmation. This is your final form of confirmation. If there was a break of structure here that was not a fake out, then obviously you know that it's going to make a downtrend. And then the last is volume and effort. So let me pull out the volume indicator. Okay, you guys can see how here, I mean, the volume was spiking here already. Price is going sideways, right? But volume is spiking. Okay, volume is spiking. So you can see here, that price spiked like crazy and price was moving in this direction. This is your first sign that the break of structure is about to happen. Okay, the break of structure is about to happen and price is most likely going to go in this direction. Okay, so first of all, you need to identify what's going to happen after this range. And then second of all, you have to identify where it's going to happen. Okay, so any questions so far? How exactly do I use volume? Okay, in accumulation, there's gonna be big volume on sell attempts, okay? But little downside result. So there's going to be big volume. Okay, how do I put this? There's going to be big volume. You see this red volume here? There's so much volume happening, but nothing's really happening on the charts, right? There's very little downwards movement. Okay, this is small, it's just this one small little candle. Okay, so smart money is absorbing. Okay, smart money is absorbing. In distribution, a big volume on rallies, but little upside results. So smart money is unloading. Okay, so I hope you guys are clear so far and you guys are understanding what I'm saying. That's all I have for you guys today. I hope this helps you understand market structure a little bit better. I mean, other than the swing high, swing low, support and resistance, which is as basic as it can get, this is basically resistance. This is basically support. If we're talking about the traditional method of teaching you guys this topic, I'll be done in 10 minutes. Okay, that's why I implemented the Wyckoff method so that we can go a little bit more in depth so that you can understand market structure from the Wyckoff point of view. Okay, so that's all I have for you guys today. I hope it helps you understand a bit better. You basically just need to identify where the fake out happened to see where it's gonna go. Thank you, was very useful. We'll try to look for these. Okay, thank you so much for joining. Thank you. Thank you, Mama. Thank you, Viola. Thank you, Brian, Joash, Grace. Thank you, Chin. Okay, bye guys. Take care. I will see you guys in a week.